You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home. And I am Victor Bals, your host for A Smarter Way Home, and welcome everybody this morning, today, wherever you're at. And my co-host,
Danielle Boote.
Hello, good morning, good afternoon.
Morning.
Okay, well, A Smarter Way Home. This is, as we go on our journey here today, last week's episode was the psychology of a home buyer. So today, we're going to jump into how do we obtain a home. And I want to talk about, there's three entities, three facets to getting a home mortgage, and that is income, credit, and debt, regarding debt to income ratios. And without all three of these, you're not getting a home loan. And so we're going to dig in and talk about one of the most important items here, and that is income. And there's several types of income, Danielle, that we have out there. And our listeners, our viewers, they may have W-2 income. They may have 1099 income. They're self-employed. They may get tips. They may have been affected by COVID. They may have went from 1099 self-employed to a W-2 employee. Maybe they're seasonal. Maybe they get commission. Are they salary plus commission? Do they get overtime? They've been on the job less than 2 years. They're part-time. They have 2 part-time jobs. They get Social Security. Maybe they get pension. They get income from annuities or streams of income from other sources. There's a lot of income out there, Danielle.
Absolutely. There's a lot to dig into and consider and make sure we document it properly. So let's go into, let's go straight into, well, first of all, you mentioned earlier that you have a couple stories about income. So before we dig into the types of income so our listeners can determine what type of income and what problems they may or may not have, let's hear about your stories. Well, we've had a couple of interesting borrowers recently that luckily we've been able to help and get closed. And they have come to us with a similar story. We had borrowers that were self-employed that said, I have talked to 3 other lenders. I want to purchase a house. I want to refinance a house, and no one can get them approved.
And why is that?
Well,
what did they say?
They said, they didn't give a lot of details, but it was situations where I've talked to 3 lenders and all I want to do is refinance my home to lower my rate. And they say that I'm not eligible for a mortgage with not a lot of detail. So it's always a good idea to get a second or maybe third opinion, especially if you're self-employed or have variable types of income.
Okay. So let's break this down. So they're self-employed.
Correct.
What type of career or job? Let's break that down for our listeners.
We had one client that is an attorney.
Okay.
Schedule C. Sole proprietor. We had another client that owns multiple businesses in multiple corporations. Okay. So he had, a personal tax return we had to analyze, and all of his business tax returns we had to analyze. So a borrower that has multiple businesses is certainly going to have layers of complexity that we have to consider. Okay. There's a lot of documentation we have to look at to get it right.
And that's also time consuming for the loan officer.
Correct. Now, with a borrower that is considered a sole proprietor or, just files a Schedule C on their personal return, that's a little bit more straightforward. So the first thing
why is that straightforward? What is Schedule C? Why is that so straightforward?
Well, a Schedule C is a document in your federal tax return that allows a person to claim all of their income and deductions for self-employment. Now, a Schedule C can be handled certainly multiple different ways. According to the IRS, you can put a 1099 on a Schedule C. So sometimes nowadays you will have customers that work several consulting positions and might get 3, 4, 5 1099s. Maybe they do the same, it's the same business, but they have separate clientele that pay them individually. That would all funnel through to one tax document on the Schedule C. So the top of the tax document would be their total income. They would then write off any deductions, and then the bottom line would be the net income.
Or taxable income.
Or taxable income, correct.
And that's what we use as lenders, is the taxable income divided by 12 to get a monthly allotment.
Correct. And the interesting thing for sole proprietors is that you, according to the IRS, you are supposed to claim income even if it's not on a 1099. So for instance, we may have a hairdresser or somebody that has tips. You know, you could have tip income that is cash. It's not easily documentable, but according to the IRS regulations, you are supposed to claim that as income. If you claim it on your tax return as income, and we can document the history, 2-year history, the likely continuance, we can use it. So the borrower that we had that was the self-employed attorney, I said to one of our loan officers, I said, well, get me his tax returns and let's take a look at them. Well, I get the tax returns, and there are various ways that we can analyze that, which we can kind of dive into. But I looked at it, ran the numbers, and went, well, this gentleman qualifies all day long. All day long. So this gentleman
So what did the other lenders miss?
I have no idea, other than if you're dealing with a loan officer or a call center loan officer that doesn't understand self-employment, they have no idea what they're reading, and they just said, I'm sorry, we can't help you. So this was a person who all they wanted to do was to get down to, I think they went to a 15-year mortgage, drop their interest rate a full %, and it was good credit, assets, equity in the home. I mean, everything was a no-brainer, but he had 3 large lenders tell him no. Wow. And the other borrower that we had, the other gentleman that had multiple businesses, it was a similar situation. I think he spoke to a banking call center. You got deer in the headlights, and they said, I'm sorry, we can't help you. And this gentleman had more than enough income to qualify him for any mortgage that he wanted. And we ended up closing 2 transactions for that gentleman.
Is it fair to say, I guess, in a cookie-cut world that maybe the online lender shops are more vanilla paper? We just want the standard cut and dry income, and we don't want to do the extra work to say, hey, this is qualifiable income? Well,
one of the things, that we've talked about this kind of in the back office, you can look, as a consumer, there is a website called the NMLS Consumer Access Site online, and you can look up a loan officer. So if you have a loan officer's name or their federal ID number, you can look up their work history. Anybody can do that at any time. And sometimes when we run into situations where, and it's not even just getting shopped for rates, right? You have a client that says, I'm talking to this person and they can't help me. Can you give me a second opinion? Well, I could look up that loan officer, and if they've only been in the business 6 months, that explains everything.
Yeah.
It really does.
We see that quite a bit. Okay, so you ended up closing the 2 deals.
Yeah.
Okay, so, and now for our listeners and our viewers here, I just want to explain some of the types of income, Danielle, and I want you to just give us your view or your take on this type of income.
Well, can we, before we even start on that topic, one thing that's very important for anybody that wants to buy or finance a home is that lenders are going to look at a 2-year history.
A 2-year history.
2-year history. Employment. It does not have to be the same job, okay? Not 2 years at the same company. We prefer to see it in the same line of work, or if it makes sense, we can create a history. So an example would be a newly graduated college student.
Okay, no history.
No history.
Of working,
anyway.
Or
they worked at Starbucks making coffee during...
Right.
While they were in college, and now they've graduated with a degree, and if they get a job in their field, we can use that college or education history. It could be a trade school. It could be a certificate program. if someone goes to school and we can say, yes, you've gone to school, you became a medical assistant, now you're working full time, we can count that as part of the history. But we need 24 months of a history to make sense out of everything.
Okay, well, let's just say I'm a stay-at-home dad. I haven't worked in years because I was taking care of my children, and now I go get a W-2 job, hourly job. Why can't I get a mortgage in 3 months?
Because you don't have a 2-year history.
Well, yeah, but I got good credit and I got assets.
But, first of all, it will depend on the loan program. Okay. Every loan program has slightly different parameters of what they will accept and what they will not accept. Now, in that situation, when it might be acceptable is, let's say that stay-at-home dad is going through a divorce.
Yeah.
So now he has to go back to work to support his family because of the marriage separating. That might make sense if everything else is strong. We might be able to get something of that nature approved. Or, for instance, an extenuating circumstance would be, I had a child that was ill. My wife was ill. I took a year off of work to care for a loved one, and if we can document that, or somebody having their own health emergency, you can say, hey, I had COVID for a year, or I had cancer. I went through treatments. I'm now healthy, and I can go back to work. Then that would be an extenuating circumstance.
And so how would you document that? With a letter of explanation and make a case to present to your underwriter?
Correct. Yeah. And if it was a medical related situation, I mean, that could be documented by, we don't typically get doctor letters, but that's kind of an extreme situation.
Okay. So I'm the stay-at-home dad. I've been off for 2 years. I decided to enter the job market again. Today I'm a welder, and then 2 months later, now I am doing asphalt toppings. How does that work when I'm changing different careers?
Well, that's going to be a little bit harder to document and harder to justify.
And I'm a consumer. Why is that? I've been working steady.
Well, not if you've only been working 3 months.
Okay.
That's not steady and reliable employment.
And 2 different careers.
Well, you might be able to tie those two together because you're a laborer.
Customer service.
Right, or laborer, general. If you're general labor, that does apply to a lot of fields.
Okay. So let's talk about income. What is W-2 income?
W-2 income is when a customer or consumer works for a company as a full-time employee or part-time, and they are paid directly from the employer, where the employee is paying taxes to, the employer is paying taxes as well, and it's all being paid up front.
Okay, and on their pay stubs, we can document their deduction, their taxes,
correct,
and all that
benefits.
Stuff there. Okay, Now I'm a W-2 employee, but I work for my family's business. How does that affect it?
Well, that's going to require that we verify that the customer does or does not have ownership in the family business. So there will be additional information requested when for instance, a lot of times you can tell because of the name of the company.
Yep. Okay. Smith and Sons.
Correct. Yeah. And even if that's a difficult. Nobody should name anything Smith and Sons because there's too many Smiths out there.
Okay. So let me ask this: I am a W-2 employee, and I work for the family business, and I own more than 25% of the business. How does that affect it?
Well, then you are considered self-employed. So then we would require the W-2s, pay stubs, personal tax returns, and business tax returns. And depending on the percentage of ownership, it might be a full business tax return we need. It might be a K-1, which is a schedule for a corporate return that would show an individual's percentage of ownership and profit or liability with the company.
Okay. I am a W-2 employee. I work for the family business. I have more than 25% ownership, and we showed a loss last year because we were off from COVID. How does that affect my income?
Well, that's going to be a very interesting case to look at. So typically, we're going to ask for 2 years worth of documentation. Okay. The COVID situation has required additional income guidelines for self-employed borrowers. Some of the things that we now have to ask for a self-employed borrower is 3 months worth of business 3 months worth of business bank statements. which are going to prove where the business is right now in an income standpoint. And we always need a year-to-date profit and loss, but that's going to have to corroborate with the bank statements to show this is how much the business is earning.
And does that profit and loss statement have to come from an accountant, or could it come from my QuickBooks?
It can come from QuickBooks.
Okay.
It can actually sometimes, for smaller businesses that don't use a software, it could be done by hand if necessary. Wow. But yes, we're going to look at profit and loss, business bank statements, 2 years worth of tax returns, and then we're going to try to tie it all together. Even if there was a loss last year due to COVID related, if everything else is solid and back on track, we might be able to get a baseline and say, okay, this is where the income's going to be for 2021, and how do we qualify this borrower properly?
So me being this self-employed, W-2'd, 25% owner of a business that showed a loss, it's going to be very difficult for me to call the big phone shops and talk about this over the phone and get a pre-approval tonight because I got to get an offer in.
Right. That's probably going to be a little painful.
Okay. So how long does it take you to analyze these documents to make sure that we're in the correct lane and we can move forward here?
Once we have everything, honestly, I can get it done in an hour
okay.
or less. You know, it depends on the complexity of the situation. One of the things that's, difficult in our line of work is getting all the documents from the borrowers. You know, many times people will send us 3 pages of a tax return when there's 20, or they send us 1 page. Here's the cover sheet of my tax returns. Well, that's not what we need. One of the things that we have at our disposal, which is extremely helpful for us, is a software called LoanBeam. So with any borrower that is self-employed in any form, we can actually take their personal and business tax returns, upload them into this underwriting system, and it analyzes the returns for us very quickly. We usually get those results back in 30 minutes or so, and it will also tell us if we're missing any documents. Yep. Now, I personally can usually tell you what you're missing because I've been doing this for so many years, but it's, again, getting those documents from the borrowers. I would prefer to get the tax returns from the CPA, to be honest with you, because they're going to send me everything.
Yeah, absolutely. Okay, so let's move on. As you can see, the income gets here a little bit difficult in some ways here, but this goes back to what we talked about last week, that home buyers will spend days, weeks, months looking for a home, but they won't sit down with the loan officer face to face to figure out what's the best plan of attack, if we can attack.
Right.
So let's go on to another type of income that we work with quite often, 1099. I'm a 1099 self-employed. I've got, for example, a painting business, okay? And what does 1099 mean, Danielle? I'm a painting business. What does that mean?
1099 is a IRS document similar to the W-2 in nature. It is an income statement that a company is going to give to a business and say, this is how much we paid you this year.
So example is this: I paint customer X's house. I charge him $3,000 to paint the house?
No.
That's not a receipt.
Well, that's a receipt. That's not a 1099.
That's an income coming.
So a 1099 is typically going to come from another business.
Okay.
If you're a painter and you paint somebody's house, yes, you're going to have an invoice and a receipt that it was paid. That becomes your income statement, but there's not a 1099 necessarily attached to it.
So if, for example, I'm 1099 and XYZ company hires me to go out to paint Joe's house, Bill's house, Susie's house, they are going to give me a 1099 each year for all the jobs that I've done.
Yes, typically yes. If they do multiple jobs, I think right now the threshold is $800 of payment. So as a company, we're going to issue a 1099 if we pay another company at least $800.
Okay. So now I have gross receipts for the year. I've done several paint jobs right now, and I report X amount in total sales. But then I have all my write-offs. How is that income treated with gross sales and write-offs? How does that work?
Well, what an accountant's going to do when they file somebody's tax returns is they're going to take the gross receipts minus any expenses.
Expenses such as
paint, rollers, drop cloths,
car mileage,
tools,
phone bill.
Yep. Whatever it takes to run the business. It could be, E&O insurance, errors and omissions insurance, liability insurance, whatever it takes to run the business is going to be subtracted. So you could have somebody that makes $200,000 a year in gross receipts, but after all the deductions, they make $50,000.
And many times we get clients calling saying, hey, I make $200,000 a year, not knowing that they had all their write-offs.
Yep.
And now they're only showing $50,000 in income, or some actually show a loss because they generate all these write-offs, and it's great for tax purposes, but it's horrible for qualifying for a mortgage.
Right. Now, if we talk, again, you talk about the situation of a painter. So most painters, as an example, probably they might not have any 1099s. Because, for instance, if they're doing a lot of residential work, they're not going to get 1099 by any of their customers. They have to keep track of their receipts, their income, and their expenses. We do see a lot of people that say, I work for XYZ company, but they're not a W-2 and they're a 1099, and they get one 1099. So it's one job. They work for one company, but the company is not paying taxes on their behalf, and they're not withholding any taxes from the employee. They're not considered an employee. They're considered an independent contractor. Okay. That customer will also have to file a Schedule C. But in that situation, the top line income is probably exactly what's on the 1099, and then there may or may not be any expenses.
Right.
It's basically a job to them.
It could be a consulting job, for example.
Correct. But sometimes you'll see a customer that has a couple of 1099s, and it'll still flow through on the Schedule C, but we're going to want to see a 2-year average of that bottom line number at the bottom of the form, not the top, the bottom, right, and average that out. And when you look at the COVID guidelines, we're going to want to see that this business is operating and is functioning well this year. And depending on the level of the loss, for instance, if there was a loss in 2020, we've got to look at it and make sense out of it. We might ask for 2 years prior to COVID to verify, yep, here's what the business was doing. Was the business in an industry that was shut down because of COVID? Because not everybody was.
Right.
So
people making face masks were surely not out of a job.
Correct. So, it has, in that aspect, we have to use some common sense. We have seen some interesting things in the last year. We have seen some people call and say, well, I'm self-employed, but I haven't worked in the last year. Well, what do you do for a living? Well, I had somebody call me that, well, I want kind of a wedding planner or an event planner. Well, certainly that industry was impacted by COVID during the shutdown last spring and summer, but the business could be back online now, and if the business is not really operating this year yet, we're certainly going to have some income stability issues. We're not going to be able to use that kind of income.
Let's move on to a different type of income. I got several clients that work in the service industry, and they get tips. They get a small hourly wage, and they make a lot of tips. Now, some of these tips they claim is taxable, and some they do not. How do you treat tip income?
Well, it all depends on how they're paid. So most service employees, whether you're a hairstylist, work at a restaurant or a bar, something of that nature, most companies will claim tips on their pay stub.
Okay, now, because a lot of people, or I don't know, most people, some people tip with the credit card, some people tip with cash. So break that down on how we can utilize income on what's reported and not.
Well, if let's say you're a server at a restaurant and your tips are coming in on credit cards, or, when people pay, they're not paying cash, that will flow through to your pay stub. Okay. And if we see a 2-year history of it and it makes sense, we will average it out and we can use it.
You said we're going to average out that income over 24 months. So let's say 2 years ago my income was X, but now last year it's a little bit lower. How will you treat that? How do you average it?
Well, that's the complexity right now. We have to look at it, and it has to make sense. At this point, it's September 2021, so we should have 9 months or 8 months of income this year to report. And people that are working are very busy. If they're, if again we could look back at 19, we'll look at 20, and we'll look at 21. And we're going to take a conservative average. So we're not going to go with the high end of things. we might be able to exclude, if we can prove, for instance, that they did not work for 3 months of 2020, we can maybe exclude those months. Or to be conservative, we're going to average it over 24 if it makes sense and take the lower kind of denominator there.
Is this a true statement that a 2-year tax history, if it is declining, we would use the lesser of the two? If it's increasing, we would average to 24 months? Is that a good rule of thumb?
Correct, yes. If we see declining income, we're going to go with the lower of the average or not use it at all.
Unless it was affected by a natural disaster and then it's an underwriting call, building a case, it could take a little extra time to figure out.
Correct.
Okay.
Let's talk a little bit about hourly employees.
Okay.
Because that is one of the biggest sections of how people are paid these days. And that is also an interesting way to average. So you can have somebody that's a W-2 employee that's salary.
Okay.
They make X amount of dollars. We divide it by 12. That's what their monthly figure is. It's pretty cut and dry. But we also have a lot of people that are hourly. When somebody is paid hourly, we're going to look at the income a couple of different ways. We're going to look at the pay stubs and the year to date to say, are they working 40 hours a week or not?
Well, stop right there. So that's 40 hours. That's considered full-time. What is the hours? Is it 28 hours a week or more you're considered full-time?
32 hours a week or more is considered full-time, and it really depends on the job. So, for instance, healthcare.
Yep.
Nurses frequently work 36 hours in a week.
Okay.
They work 3 12-hour shifts. So their standard is going to be based off 36 hours, not 40.
Okay.
And we can see that, and we can ask the client, how many hours do you work?
You brought up a very good question because, this nurse works 36 hours, okay? So she's getting time and a half or she's getting overtime for those hours in many cases. But you said we need a 2-year work history. What if I haven't been a nurse for 2 years? Can you still use my overtime?
We can if it's likely to continue. So again, if you have let's say we have a nurse who just graduated college, he or she has been working 18 months. We can look at that history and say, yes, this is standard. For instance, they get shift premium for second or third shift. They might get bonuses, things of that nature. There can be a lot of overtime. We're going to have to drill into all of that and say, does the base pay make sense? And what is the average overall?
Okay.
So the longer the average, typically the better off we're going to be.
Well, on many of the healthcare workers I've seen on their pay stubs where they get an X amount hourly rate for hazard pay, COVID pay. Can I use that for income?
We should be able to, yeah.
And even though it's going to end soon or there's maybe not likely to continue?
We don't know. I mean, there's a lot of change in the healthcare industry.
So would you just take a conservative approach on that and not count it if possible?
Well, it depends on how it's listed on the pay stub.
Okay. I've had another client here that was a W-2 employee, got fed up from the pandemic, says, look, I'm going to start my own business and I'm going to be a 1099 or self-employed individual. How do you treat that?
Well, that's a good one. First of all, we want to see if they're in the same line of work, and we're typically going to need at least 1 year of tax return showing what this borrower is making. So if they just made that shift 3 months ago, they're probably not going to be able to buy a house.
Now, is this they just want to see what I make, or are they looking that I have the ability to sustain and manage a business?
They're looking to see what you make. I mean, it's from the mortgage standpoint, it's all numbers or income based.
Okay, yeah, that gets a little tricky too.
And it depends on the loan program. So, VA, for instance, is very strict with a veteran on what their income is. So on a VA loan, you're going to need 2 years solid worth of tax returns. Typically, FHA is going to want 2 years. Conventional rural development's going to want 2 years. All the government programs are going to need 2 years. If it's strong conventional and it makes sense, we may have the opportunity to use 1 year of tax return instead. But again, I would hope, let's say somebody became self-employed in February of 2020. If they had 2020's tax return and now it's September of 2021, I've got 8 months worth of income history that I can then get a profit and loss and the bank statements and go, okay, How is the business doing in 2021 compared to last year? And at this point, we've almost got a 2-year history, but 1 year of tax returns.
Again, take some time to put all this together to get in front of an underwriter to build a case for our clients.
Yep, absolutely.
So now I am that stay-at-home dad. I can't get a job out there, so I decided I'm going to start my own business cutting lawns, and now I'm seasonal. What would be the requirements for me being stay-at-home dad, starting a business on a seasonal job? What would you need for me to qualify?
It's still going to be that we're going to ask for the 2 years worth of tax returns. And it doesn't necessarily matter to us if it's seasonal as long as the history is there. So let's say you have a landscaping business and all they do is cut grass. So in Michigan, that's about a 6-month window.
Right.
Most landscaping companies will plow snow in the winter. So it really makes them a 12-month company. We're going to average that income over 12 months. So you could technically have a legitimate full-time business that most of their income comes in a certain time of the year. Mm-hmm. We're just going to average it over 12 months, to come up with what the income average is.
Okay. So I am that stay-at-home dad. I go to start my own business tomorrow, and I got to get a house today, and I know we can't use my income. Could a cosigner help me out? Would you need my income?
Possibly, yes. That we do have loan programs where a cosigner might be able to assist in creating, a strong income base for the file so it can get approved.
So basically that cosigner would cover my income as long as he qualifies with his debts and my new debts, but you can use my credit.
If the cosigner is a family member, yes.
Oh, good. Oh, and what if it's not a family member? Can I have Barstool Billy, our old metaphor, Barstool Billy? Can he cosign for me?
Well, you and Barstool Billy could buy an investment property together, but you cannot buy a primary residence if he intends to not occupy the property. I mean, that's getting a little bit more detailed.
Okay.
We need to know the intent to occupy. So if one borrower is going to be a primary resident and the other borrower, we know he's not going to live there because he's got another house, then that would be...
Okay, I really need a family member to help me out here until I get 2 years work history.
Correct.
Okay, very good here. So let's go with this. I'm salary, but now they just lowered my salary. Now they're putting me on commission.
Ooh.
Okay. Let's talk about commissions.
Oh, commission employees. Yeah. And with commission or any variable income, okay, the same thing for bonus or overtime, we want a 2-year history to be able to document that income. So someone that was W-2 and goes to commission, even if they're at the same company and still W-2, we now have variable income. So we cannot use that.
We can use my W-2 income. We can use that.
Okay, no. You can be commissioned in W-2. You're commissioned and you're W-2.
I know, but let's say I'm W-2'd, but they cut my salary from X to this, and now part of it's going to go commission.
Then we can only use what the lower salary is if we have no history of the variable income.
I got to be there 2 years to start utilizing that commission.
Typically.
income.
Now, could there be a unique situation where we could get somebody just under 2 years? Maybe.
Okay.
So let's say we had somebody that had a year on their last W-2. And again, in September of 2021, we've got 8 months of history.
Okay.
Then we've got 20 months worth of history. We might be able to use it if it all makes sense. But sometimes what an underwriter could do to be conservative is say, well, I'm going to average the 18 months worth of income over 24 months.
Right.
So that we're using a lower, very conservative
So we got
estimate.
some time on there, and it kind of makes sense because I got a history. Okay, I work at a widget factory, and I see the glory of if I went into sales and I decided to still work for the widget factory, but go 100% commission because now I'm going in sales and I need to get a house. How do you treat my
get
income?
paid per widget that you create?
Yeah.
That could happen.
Yeah, but can you use that income if I went from a totally W-2 and now I'm 100% commission for the same company?
If you got a 2-year history of it.
Of getting commission.
Correct. Because that's a variable income.
So
it is not tied to anything that's going to be regular.
So, and that's one of the things we always preach here is things not to do is don't quit your job, don't change, don't do nothing until we understand everything there.
Yeah.
Okay, let's talk about part-time. Danielle, I'm that stay-at-home dad, but I decided to go get 2 part-time jobs. How do you treat part-time income?
How long have you been doing your 2 part-time jobs?
I've been doing them each a year.
Well, in order to use secondary income, we have to have a 2-year history.
Why is it secondary income?
Well, okay. We could potentially, again, you got 1-year job history, that's not strong.
Okay.
Could it be used? Let's say his wife has a good job.
Okay.
She's making the money. We've got her income, and he's got a year history. Okay. On a conventional loan, you might be able to use that part-time job.
Okay.
Okay. You're not going to be able to use 2 part-time jobs because you don't have a 2-year history of working 2 jobs. So secondary income can be used if the borrower has a history of working 2 jobs.
Okay. I've been a W-2 employee for 20 years. Okay. Very easy. And I took on a part-time job 6 months ago. Can I use that income?
No.
And why can't I use that income? I got a 20-year history here.
It has nothing to do with your primary employment. You do not have a 2-year history of working a second job.
Jobs.
Yeah.
Okay, it does get a very complex, in a sense, easy, but
now
complex.
there are some people that work 2 jobs, and if you have a 2-year history, again, it doesn't have to be the same employer, but if you have a 2-year history of having a full-time primary income and then a part-time secondary income, then we can use it without a problem.
Okay, you know, I'm getting towards retirement. I'm going to retire next month, so I'm giving up my job, but I'm going to collect Social Security, and I don't have a 2-year history of collecting Social Security. How would you treat my Social Security income?
Well, when it comes to fixed income,
okay,
we need to verify that it will continue for 3 years. So when someone reaches retirement age and retires and gets Social Security or pension, annuity, any of that would be considered a fixed income.
Okay.
If they are of retirement age, we know that the Social Security will continue until.
Are we sure about the Social Security system?
No, we're not. We are not sure about that, Vic. But that's not. We are not talking about that.
Okay.
But we know that. For instance, with Social Security, there is a difference between a retirement benefit and sometimes a disability benefit.
Okay.
So you could have a borrower that is disabled, that is under the age of 62, and that could change. So you could have somebody that had a short-term disability, they got Social Security disability for a few years, and then when they're well enough to go back to work, their Social Security is going to go away. Okay. So if someone is under the age of 62, we may ask, will your Social Security continue? Okay. If they're of retirement age, we know it's going to continue. So you could say, yes, I'm retired. You know, here's my Social Security statement. We can use that because we know where it's coming from. The same thing with pension and annuity. And, you know, the challenging thing with retirement, though, is this. If a borrower tells us that they're retiring in 30 days, but they're salaried right now, we're not supposed to count the salary, right? Because we know it's not going to continue because the borrower told us. So we do have to be careful with that. You know, sometimes when people retire right away, it takes a few months for all of that retirement income to kick in. So that's not the prime time to buy or, you know, potentially look for financing because you're going to have kind of an interruption there.
Okay, I've been retired a couple years. You know, I'm getting Social Security. That's going to last forever. But, you know, it's not that much income. I heard you can gross up my income on Social Security. Can you explain what grossing up income means?
Sure. When we qualify a borrower with any income, we're going to use the pre-tax number. So if you are salary, right, let's say you make $100,000, but we know you're going to pay Social Security taxes, federal taxes, state taxes, benefits, Medicare, all of that's going to get taken out, okay? We qualify you on the gross.
On the 100,000.
Not the net, correct. When it comes to retirement benefits, such as Social Security, sometimes they're taxed and sometimes they're not.
Why would they be taxed? Why would Social Security income be taxed?
If you have income from other sources that exceeds whatever the IRS limit is, then sometimes Social Security is taxed.
So I have no other income coming in except Social Security. How does that fundamental...
Well, then it won't be taxed.
Okay.
And then what we can do from a guideline standpoint is gross it up 15% to offset those deductions.
So if I was making $1,000 a month, you can actually gross it up to $1,150 a month to help me qualify for more.
Correct.
Wow, that's pretty nice.
It can be. And the other thing that with Social Security too that's important to realize is that many times the retiree will have Medicare benefits taken out of their Social Security check monthly. That's standard.
$110, whatever
something
that
like
is.
that. Yeah, whatever that amount is. But we want the top line number. We don't want after the Medicare deduction. We want before.
We could take the biggest number, add 15%, and hopefully get our buyer. Well, it gives us a little bit more impact. It
does, but in that situation, we're going to have to get the borrower's tax returns, right? Because we have to prove
see what was taxable.
We have to prove that they didn't have to pay tax on it. So if somebody is still working, there's a threshold there, right? If you make too much money, your Social Security might be taxed. If you have other assets, like you might have a retiree that got their Social Security, but they've got pensions and they're pulling money out of their retirement, their 401k, their IRAs, then that could trigger a taxable event with Social Security.
It takes them over their minimum threshold before they get taxed.
Correct.
Okay, and let's move into another type of income is annuities, income streams from investments. I don't really have income. I live off my investments. How does that work, Danielle?
Well, that should be pretty easy to document. And we've seen that. That can happen at any age level. For instance, I've had borrowers that had an income stream from a family trust. Well, that's all documentable. So we're going to be able to get a trust document that says how much they're receiving. We're going to be able to document with bank statements. And typically that'll also be taxable. So it will be on their tax return. You could have a retiree that is pulling income from their IRAs, their 401ks. And again, it's all going to come through on their tax return. So in those cases, we're going to ask for 60 days worth of bank statements to document the assets, 2 years worth of tax returns, and then we'll be able to put together, what actually their income is.
Well, it's kind of funny, as we wrap up the show here. It seems like there's more complex things about income than the
simple,
easy parts about it. And is it fair to say that our consumers should be consulting face-to-face with a loan professional and get the story before they're out there shopping for a house?
Absolutely. Because even with retirement, you will have realtors go, oh, this person's retired and I know they got great credit. It should be cut and dry. Well, that's some of the most complicated borrowers, to be honest with you, and they don't think about it because you could have an individual that, guess what? They had perfect credit for their whole life. 40 years, they worked, they did everything right, and then when they retire, they're like, oh, it should be good. I got 800 credit scores. Well, we have to document your income. And in the way the mortgage guidelines have changed in the last, 12 to 14 years, we have to document everyone's ability to pay. We cannot treat anyone differently.
We don't care if you have $1 billion in the bank. We got to have an income stream in.
It's got to be on paper.
It's got to be on paper.
It doesn't matter if you're putting 50% down. It doesn't matter if you're putting 0 down. We have to prove all borrowers have the ability to repay. So we need the documentation. And, as you can imagine, I had clients that we just closed actually on Monday, both retired, very, very sweet couple, but we had a lot of paperwork to get together. And sometimes, for retired borrowers to think about pulling, wait a minute, you need my tax returns, my bank statements, you need this, you need that.
You're throwing me under the bus.
Correct. And they will argue sometimes because why do you need this much paperwork? I've never paid anything late in my life. I understand you've never paid anything late in your life, but the government guidelines require that we prove that you have the ability to repay the loan.
Trust but verify.
Yes, yeah. So that's where the complexity comes in. And what if we don't ask for the right document? Right. And this is where our customers have run into issues with other lenders. They're not asking the right questions, they're not going deep enough, and they're not figuring out what actually the income situation is. Right. Or sometimes you might have what if somebody got a raise? They might have been with the same company for a couple years and they just said, I got a promotion. I'm making $20,000 a year more. I actually had this happen where a borrower right now got a $10 an hour raise. First time home buyer, 0 down. And he got a $10 an hour raise. Well, we can use that. In fact, we must document it because on the rural development program, we have income limits and all that stuff to worry about. But we then need a letter from the employer. Or somebody, and here's one thing we didn't talk about. What about somebody that's just transferring in to a new job from out of state or anywhere, right?
Yeah.
New company, new job. Well, then we need a signed job offer letter and a pay stub within 30 days of closing in most cases, depending on the loan program. So, there's just a lot of moving pieces. And if we don't ask for the right documentation and get it, we're not going to give people the right answer.
And you brought up a good point about getting raises, because we have many clients that, they're right in the top line of their borrowing budget, and they come to find out they're getting a couple $1 an hour raise. And we know if we can document them getting that raise within 60 days with an offer letter, we can actually use that income for qualifying.
Absolutely. Yep. Or how about income interruptions?
Yes. To explain that, Danielle.
Well, when you apply for a mortgage, you're signing a federal document stating, this is who I am and this is how much money I make and these are my assets. I want to start a loan process. And when we go to closing, you're going to sign a final application that confirms, here's who I am, here's my income, and here's all my asset and liability information. If a borrower, anytime during the loan process prior to closing, has any income change to the negative, we need to know, because we're going to verify their employment within a couple days prior to closing. And if the employer says, oh, Sally Smith was laid off on Friday, we can't close on Monday, because now that continuity of income has stopped and we can no longer use that. And we occasionally get, we probably, out of our little branch, we might have one borrower a year that quits a job, changes jobs right before closing, and they don't say anything. Yeah. And then we have to stop the presses, go back to the borrower and say, your employer just said you're no longer working there. Did you start a new job? What's going on?
Yeah, now we got to document everything on the new job.
All over again, and hope that they still qualify. So, that's why as lenders we say, can you kind of not have a job change during the loan process? Yeah, I had a borrower a couple years ago, and it was not my client; it was one of my loan officers. And this gentleman, we literally had him clear to close. We were calling to do the final employment verification, and he quit his job.
Nice.
2 days before closing.
Wow.
And when the borrower, so the loan officer called and verified, hey, what did you do? Well, he goes, I'm starting a new job. I got a $25,000 raise. Okay. And I start my new job on Monday. It sounds good, but he was a rural development loan, zero down.
Over the income limit.
He went over the income limit. So not only did we have to stop the closing,
change programs.
Now
he needs money to close.
Now, we had to put him on an FHA 3.5% down program. It cost that person it was like 10 or 12 grand because it was crazy, and we were like, oh my gosh, if you would have waited a week or two to switch jobs, we would have had no issues. So it delayed closing, had a complete loan program change, and the borrower, it was just it's a crazy situation, but sometimes borrowers don't think about all of the moving pieces, and we will verify everything to the date of closing. So. You can't go out and buy a car or a big vehicle. We're going to find out about it. Don't go vehicle shopping the day before closing.
That wraps up today's show. And you brought up a good point about that was the ability to pay. And you brought up a point about credit. Well, I've got great credit. We're going to talk about credit next week here and talk about all the facets of credit and how it can help you or hurt you or kill the transaction. Any closing words, Danielle?
No, it goes back to, hey, if you need a second opinion on a mortgage, pick up the phone and call, because you might be getting the wrong information. I think that is important, in working with a knowledgeable, trusted professional can make or break your ability to buy a house.
Well, that's Danielle Boote. I'm Victor Bals for A Smarter Way Home. And you got to remember, we got to all come together and make this world better and try.